Welcome to The Explainer. Today, we're digging into the wild story behind the latest earnings report from 1-800-Flowers. They posted a pretty significant earnings miss, which somehow led to a huge rally in the stock. We're going to break down exactly how that happened.
Right, so this is the big puzzle we're here to solve. How on earth does a stock that's down 10% before the market even opens end the day up almost 4%? It's a classic Wall Street battle, really, pitting the cold, hard numbers against a compelling story about the future. So let's dive in.
Okay, first up, a quarter of contradictions. We're going to start by unpacking the headline numbers that dropped before the opening bell. And honestly, on the surface, things looked pretty bad.
So right out of the gate, you can see the company missed on everything. They missed on profits, they missed on sales. Normally you see that, you just know it's going to be a rough day for the stock.
And this wasn't just a little miss on earnings. They came in 24 cents below what analysts were expecting. That's a pretty substantial gap. That's the kind of number that makes people nervous.
And here's the other thing. This wasn't just about missing a forecast. Their actual revenue shrank by over 11% compared to this time last year. So the business is actually getting smaller right now, which is a real red flag.
In this slide, well, it just drives the point home. It's not just that sales are down. The profitability on each sale they do make is getting weaker. Gross margins fell by 2.4 percentage points. That means they're making less money on every single dollar of sales. Not a good look.
So, with a financial picture that bleak, why the rally? Well, that brings us to management's game plan, the turnaround playbook. This is what investors clearly decided to focus on instead of just looking in the rearview mirror.
During the earnings call, management laid out a really clear three-step strategy. Step 1, bring in some new blood. A new marketing chief from a retail giant like Home Depot. Step 2, get their products in front of more people by selling on huge platforms like Amazon and Walmart. And 3, get serious about cutting costs.
Now, here's a really crucial part of the story. They talked a lot about this idea of marketing contribution margin. What does that mean? Basically, they're done with just chasing sales growth for the sake of it. From now on, they're going to be laser-focused on making sure every dollar they spend on marketing is actually profitable. It's a huge shift from growth at all costs to smart, efficient growth.
And the CEO was super direct about this. He basically said, look, don't expect crazy growth this year. Fiscal 26 is a year of stabilization. They're focused on shoring up the foundation of the business and getting the fundamentals right.
Okay, so this new strategic story from management really created a split personality in the market. It became all about the ugly present versus a potentially very promising future.
I love this slide because it shows you the two competing stories perfectly. On one side, you've got the street, just looking backward at the awful results from the quarter. But on the other side, you have the traders, looking forward at the story, a credible plan, new leadership, and a big, juicy savings number.
And in the end, well, the story won, big time. The stock pulled off this massive reversal, swinging almost 14 points from those pre-market lows to the closing bell. Traders were clearly betting on the future, not the past.
So, management sold the story, great, but now comes the really hard part. They actually have to deliver. So what are the key things we'll all be watching for over the next couple of quarters to see if this turnaround is for real?
All right, these are the big ones. The absolute most important is the holiday season. It's totally make or break, and we need to see not just sales, but those contribution margins we talked about. After that, we need to see if they're actually getting any traction on Amazon and Walmart, and we need to see real progress on those $50 million in savings.
All right, so taking everything into account, the bad results, the hopeful new strategy, and the very real risks, here's our call on the stock.
We're initiating coverage with a market perform rating. Why? Because the turnaround story is absolutely compelling. But let's be real, the path forward is risky, and there is no guarantee they'll pull it off. So here's our thinking. The market has already given the stock a bump for the plan, which kind of limits the easy gains from here. This is a classic show-me story now. The stock's been hammered, down 36% last quarter alone, so a lot of bad news is priced in. But we expect it to be pretty choppy until we see those holiday results. And really, this is the final question it all boils down to. Management seems to be doing all the right things inside the company. But is that going to be enough to fight the headwinds outside the company, like a tough economy and cautious consumers that are hitting the entire industry? And as always, just a quick reminder, this analysis is for informational purposes only. It is not financial advice.